All right, let's dive right into it. Today, we're unpacking the ICT anticipatory trading model. Now, this is a big one because it completely flips the script on how most people approach the market. We're not talking about reacting to price. We're talking about a framework to anticipate where price is going next. So let's get into it.
And this quote, this really is the whole game right here. Traders must anticipate price delivery, not react to it. This is the core philosophy. See, professional trading, the way ICT teaches it, is all about prediction. You're basically a forecaster, figuring out where the market is headed, not just running behind it trying to catch up.
So you're probably thinking, okay, how do we actually anticipate anything? Well, it starts with a fundamental belief. The market isn't random, not at all. It's an engineered mechanism. Think of it like a smart machine that's always moving towards one thing: liquidity. Our job as traders using this model is to figure out where those big pools of buy-side and sell-side liquidity are, because that's the market's next destination.
Okay, so to make this happen, the entire framework is built on 4 pillars. You've got your higher time frame bias, that's your North Star, then liquidity objectives, that's your target, delivery state shifts, that's spotting the change in momentum, and finally, time-based volatility windows. We're going to break these down, but just know, these 4 things are the whole shebang.
All right, section 1. This is your anchor, your foundation, the higher time frame bias. Seriously, if you don't get this part right, nothing else we talk about is gonna work.
So here's the number 1 rule, and it is non-negotiable. Your daily chart, that's the general of your army. It sets the directional premise for the day, maybe even the week, and every single move you make on the lower time frames, the 15-minute, the 5-minute, the 1-minute, has to be in line with what that general is telling you. There are 0 exceptions to this rule. And this slide just lays it out so clearly. Look at the difference. The amateur trader, they're down in the trenches on the 1-minute chart, getting absolutely thrown around by every little tick, flip-flopping their bias constantly. It's pure chaos. The professional, they're using that intraday noise for one thing and one thing only: to see if their daily narrative is holding up. They're looking for confirmation, not getting their direction from the noise.
Okay, so we've got our direction locked in. Now let's talk about a very specific pattern you need to look for. Think of it like a coiled spring. We're looking for that moment of compression right before a massive expansion.
And the textbook signal for this compression is what's known as an inside day. It's super simple to spot. It's just a daily candle where the entire range is inside the range of the previous day. When you see this, you need to pay attention. That's the market consolidating, building up energy. It's like it's taking a deep breath right before a huge, explosive move.
So here's how that plays out. It's a 3-step process. First, the market compresses. You get that inside day. While that's happening, what's really going on is that liquidity is being engineered, just building up above those highs and below those lows. And then, step 3, bang! You get this massive one-sided directional expansion. All that stored energy gets released, and it usually moves fast.
So we've got our bias. We see the market coiling up. The next big question is, how do we actually get in? This is where we zoom in and look at the multi-time frame execution model. Think of it like a funnel, from big to small. You always start at the top, on the daily chart. That's where you get your bias and figure out where price is ultimately trying to go, your draw on liquidity. Then you funnel down to the 15-minute chart. Here, you're just mapping out the important structural points and key levels. And only after you've done all that do you drop down to the 1-minute chart for the final step, precision entry.
Now, when you're down on those lower time frames, you're not just guessing. You're looking for very specific clues, specific confirmation tools. Things like the Judas swing at the open. That's a classic manipulation pattern. You're looking for a clear shift in the state of delivery. And a really powerful one, you're looking for smart money divergence, or SMT.
Let's zoom in on SMT because this is a huge one. It's when 2 markets that are normally tied together, like the S&P 500 and the NASDAQ, start to disagree. Imagine you're at a key high. The ES pushes up and makes a new high, but at the same time, the NQ fails to make a new high. That disagreement, that divergence, that's a massive red flag. It's a high-integrity signal that the move is probably fake and a reversal is coming.
And this might be the most important rule of all. All those patterns you hear about, fair value gaps, order blocks, what ICT calls PD arrays, they are completely 100% useless on their own. They mean nothing in a vacuum.
A fair value gap only matters if it shows up at a key high time frame level during the right time of day and it aligns with your daily bias. Without that context, it's just noise. Context is everything.
Okay, so you've got your bias, you've spotted the setup, you've nailed the entry. We're almost there. Now we have to talk about the end game, picking your targets and having the right mindset.
So where are you aiming? It's actually pretty simple. The market is lazy. It always takes the path of least resistance. So your first target should always be the nearest, most logical pool of liquidity. Don't try to be a hero and swing for the fences. Take the easy money that the market is offering you first.
Now let's talk about mindset, because this is what separates the pros from everyone else. Your job is not to focus on your P&L. I'm serious. Your job is to focus on your execution of the model. At the end of the day, the only question that matters is, did I follow my plan perfectly? If you do that, the money will take care of itself. That's the real win.
Okay, let's put it all together in one final checklist. This is the entire institutional model, from A to Z. 1. Define your high time frame bias and draw on liquidity. 2. Map your key levels. 3. Watch for that opening manipulation, the Judas swing. 4. Spot the shift in delivery after a liquidity run. 5. Confirm with SMT. 6. Execute your entry. And 7. Target that nearest pool of liquidity. That's the whole process.
So, I'll leave you with this one question to think about. Take a hard look at your own trading plan. Is it actually built on anticipation? Do you have a systematic process for figuring out where the market is likely to go next, or are you just reacting to the chaos, chasing price around all day? It's a simple question, but the answer really changes everything.